Okay, hey, I wanted to post my first trade idea. With my school, we utilize a top down approach. It's fundamentally based. That's why I said top down. So, focusing on macroeconomics when I start. And then we develop the long short ideas and apply various option structures. And as mentioned before, we aim for the 20 to 60-day time frame. So, I wanted to mention a trade idea I have on Celsius, and that's what you see here. Um, the macroeconomic context that's relevant for Celsius is the ongoing trend of consumer preferences that are shifting towards healthier alternatives, like better for you beverages. So, as inflationary pressures have softened a bit and consumer spending habits stabilize, there's been a stronger demand for the wellness focused products, including like functional beverages like energy drinks that have healthier ingredients. So, Celsius, what they have is sugar free, low calorie, trendy drinks. And because of that, they're going to be supported by that health conscious movement among consumers. So, that's initially why I was looking into them, because it fits my portfolio and some of the other trade ideas that I have. So, let's see. Let's get into some tailwinds that could potentially support my idea, and then I'll get into some headwinds as well. So, the tailwinds are one of what I just said, the growing health and wellness trend, being a major factor in driving their earnings growth. But another tailwind is their partnership with PepsiCo, for distribution that's giving them an edge in expanding both domestically and internationally. So, some brief headwinds. They face competition from giants like Red Bull and Monster. So, they're ramping up their own healthy alternatives to compete. And of course, there's always the onset of potential economic uncertainty and rising costs that could impact the company. But ultimately, the overall trend remains positive. And also, not just the overall trend remaining positive, this is the options chain for it. This stock has been beaten up quite a bit. Let's see, let's go 1 year. Let's see it day by day. So this stock has been pretty beaten up. I'm not about to go through any serious technical analysis there, but they're them getting beat up is essentially because of their inventory issue that they had with Pepsi, and essentially, I guess Pepsi was ordering too much, and they cut back basically on their orders because they had so much in stock. So after a few quarters of getting beat up, I think this stock could be poised to break out of this serious downtrend that it's been in, and so hopefully they come with the next earnings or even something in between, new flavors, or customer retention that could put them in a position to make some more money. So let's see what else. So I went through the tailwinds and headwinds. So let's get into the trade structure. That's the screen I was on before. So for this trade structure, let's look at the March 30 strike calls. So we could go for a March 30 strike call, $251. And against that, we could sell the Feb 35 calls. So each one that we put on would be $205 for that spread if we did it on a 1-to-1 ratio. So at this point, let's go to the, let's assume we have a $30,000 portfolio. And so if we assume we have a $30,000 portfolio, then we could have position one. We could do 7 of each. So if we do 7 of each of those, then that'll give us a net spend of $1,435. That's just 205 times 7. And in a best case scenario, two scenarios, excuse me. So profit target scenario 1, if the stock is below 35 at the February expiry, we'll get to keep 100% of what we sold those 35 strikes for, and we'll get to keep that $322. But if it's above 36 by the March expiry, then we'll make $2,443, and that's just 36. That's the price at expiry minus the 30 strike, which is P1, position 1, plus $2.51, which is what we paid for it up front. So our total profit will be the 2443 plus the 322, and that total profit will be $2,765 divided by the $1,435 net spend initially, gives us a 1.9x or 190% return. Now, my profit target scenario 2 is still the stock price is below 35 at the February expiry, but it's above 38 at the March expiry. So our profit at that point, P1 on position 1, is 38 minus 30 plus 2.51. It's multiplied by 7 contracts times the 100 multiplier, and it'll give us $3,843. And also still collecting the 322 on position 2, and our total profit would be $4,165 divided by $1,435 will give us a 2.9x return, 290%. And of course, as you could see, the most you could lose is the entire $1,435 by March 21st, 2025. But we have different things that we could do to mitigate those losses or reduce those losses if we are seeing that there's something fundamentally material in the trade that has changed and made me feel differently about going along this particular stock. But I think looking at the potential tailwinds and the short interest and also the price action, this trade could potentially, if I'm right, this trade could be poised for a good breakout. So I hope this makes some sense, and thank you for watching my channel. If you like this trade idea, make sure to hit the like button and subscribe for more actionable trade setups. And let me know in the comments if you're considering taking this trade or if you have any questions. But the reason why I don't recommend you take the trade, I'm talking about what I'm doing. The reason why I don't recommend you take this trade is because you don't understand the full context of the entire portfolio that I'm putting this trade on in. I'm fully diversified, and this type of idea is different from all of the other ideas and the reasons why I put these trades on in my portfolio. So because of that, I don't recommend this trade idea at all for anybody that's watching. But at the very least, I want you to understand why I put the trade on. Thank you for coming to my channel. Take care.